a good time to invest in equities? That's the million-dollar question in these volatile times. Well, let's look at Europe, for instance. Some markets are actually outperformers. Take the FTSE 100. It's down more than 11% so far this year. But that is better than the Euro Stoxx 600. That index has fallen by more than 18% in the same period. So does that mean that the UK markets are a safer bet? Well, for more, let's talk to Richard Bayley. He's a technical analyst at Collins Stewart. Now, Richard, it's good to have you on the program.
Thank you.
First of all, I want to just start out with what you're telling us. You're telling us that we are about to see the FTSE 100 reach its highest level since the end of the dot-com bubble.
Well, yes.
When's that going to happen?
Well, that's obviously the million-dollar question. The key here is to, when you've got market volatility at the moment, is to understand the structure of the marketplace, to zoom out. Every day we're always called up and down. You don't see the pattern in the marketplace. In the pattern, you have the big bull market, the dot-com, and since then you've had key turning points.
Show this chart of the FTSE 100 that you've brought for us that shows the pattern. So this is what you say, you zoom out and you look at the pattern over the last several years.
So the bull market is up to December 99 was the dot-com bubble. So we assume that's a big move there.
Yep.
And then since then we've had a classic ABC retracement. So March 03 was an A move down, that was the bear move there. And then from then you had the start of the credit bubble, and that took us through to July 07, finally resolved itself. And then right down here, May 09 was the final bottom of that big ABC classic
Elliott wave. Is it the Elliott wave theory? So that theory, let me just work this out here. It actually, it's a five-part move.
Yes, you have a 5-part bull move, and then that's followed by a 3-part retracement. And then that pattern repeats itself going forward.
So we're in the middle of that 3-part retracement now.
We've had the 3-part retracement. The bottom of that was May 09.
Let's just show this other chart that we've got of the FTSE 100, which I think shows us that bottom here.
Yes, we've come up the top of that part one move of a 5-part bull market was the top here in August 11. And at the moment, we're in part 2 of that retracement. Now, we're trying
so we've got further down to go. So you're saying actually we could see a drop in the FTSE 100 in the near term of as much as 15%.
Yes,
right?
We do have a fall to make. Before we can make this big bull market move, we have this fall. And the FTSE here is a classic sort of wedge pattern here. You have a fall, then a wedge, and usually you have a fall again, which takes us to the completion of this two move of this 5-part bull market.
So when we drop again,
yes,
that's when you want to buy. That's the buy signal.
When markets sentiment is at its worst, people have thrown in that final towel. That big, huge.
And then how long do you need to hang on to it before you get to this level where you say it would be the best since the dot-com bubble?
The interesting thing here is how markets are very similar, in fact, to 2008. And you've got reversal happening at the moment. Asset allocation sectors are moving towards. They're seeing this bottom coming, and people are positioning themselves for it. So you're starting to get the big value stocks coming in here. The big Tesco's are starting to outperform, and you're having all the industrials still underperforming. Over the next few months, you're still going to get a big move, and very much indicative of that is the big move you've seen recently in the DXY. This is very similar to pre-Lehman's. So Lehman's, the DXY, is sort of this risk indicator for the dollar. People piling into the dollar. This is broken out, and that is what's going to lead the FTSE down over the next month or so and finally get you that final bottom. But when market sentiment is at its worst, that will be the point to get back into the market.
Now let's talk about technical analysis for a moment. I mean, this is your preferred method of investing. Do you look for fundamentals to back this up, or is it really purely about the charts?
A pure chartist would always say, the price tells you everything, and that's all you need to do, just follow the price and ignore all fundamentals. Truthfully, you do have to tie in a few fundamental stories. It makes it such more a complete picture and allows you to really fully understand what's going on. If you just look to the price, you could easily be taken in the wrong direction. But the truth is, if you can try and use the two together slightly, then you'll have a much better
So what are the
performance.
fundamentals that back this up? The idea that we're going into a recession, and that's why we're going to see stocks fall along with that, and then we're going to come out of it at some point and go through another extended period of growth in the world?
You have to believe, ultimately, that we're going to grow it. In the long term, markets do really go up. We always have this fear effect. As we're humans, we get big moves in the market, we retrace ourselves.
But I thought we were looking at a new normal. Not the kind of growth that we were looking at before.
The new normal, this time it's different argument.
Yeah.
No, you have to assume ultimately markets go up. Otherwise, I think
Otherwise, your glass is definitely half empty.
yes.
Okay. Richard Bayley, technical analyst at Collins Stewart Europe. Thanks very much.
Thank you very much.